Chapter 12. Reporting and Interpreting Investments in Other Corporations. There are several reasons for a company to make investments in other companies. Some companies may wish to make passive investments of idle cash to receive a higher rate of return on their money. Many companies make investments for strategic or competitive reasons so that they might exercise influence over the other company's policies and activities. Finally, some companies buy a sufficient amount of another company to be able to control the other company. Part 1. Passive investments are made to earn a high rate of return on funds that may be needed for future purposes. Passive investments typically involve smaller sums of money than do the other types of investments that we will cover. Investments in debt securities are always considered passive investments. Part 2. In the absence of other information, investments in equity securities are presumed passive if the investing company owns less than 20% of the outstanding voting shares of the other company. The investing company is not interested in controlling or influencing the other company. Significant influence is presumed to occur when the investment ownership percentage reaches 20%. At that level of ownership, the investing company has the ability to have an important impact on the operating and financial policies of another company. When the ownership percentage exceeds 50%, the investing company has control over the other company. At that point, significant influence has turned into the ability to actually determine the operating and financial policies of another corporation. The method used to account for investments depends on the type of security, debt or equity, and the level of ownership, influence, if the investment is in equity securities. Investments in debt securities are always considered passive investments. When management plans to hold an investment in debt securities to its maturity date, the amortized cost method is used. When management plans to sell the investment in debt securities before the maturity date, the market value method is used, where the security is reported at its market value on the balance sheet date. Passive investments in equity securities, less than 20% ownership, are also reported using the market value method. Investments in the equity securities of another company resulting in ownership percentage between 20 and 50% are accounted for using the equity method. Consolidated statements are prepared for investments in equity securities of another company that result in greater than 50% ownership. Consolidated statements combine the operations of the companies into a single set of statements. Investments in debt securities are initially recorded at cost. Interest received from the investment is recorded as interest revenue. The investment may be acquired at a discount or premium to the maturity value. Discounts and premiums are amortized at the time of each interest receipt, bringing the carrying value of the debt security to the maturity value at the maturity date. At maturity, the investing company receives the maturity value of the debt security. Let's look at an example where bonds are acquired at the maturity value, par amount. Part 1. On July 1, 2008, Washington Post paid the par value of $100,000 for 8% bonds that mature on June 30, 2013. The 8% interest is paid on each June 30th and December 31st. Management plans to hold the bonds until maturity. Let's prepare the journal entry to record the investment on July 1, 2008. Part 2. To record the investment, we debit held-to-maturity investments and credit cash for $100,000 on July 1, 2008. Now, let's prepare the journal entry to record the receipt of interest on December 31, 2008. We record the initial receipt of interest by debiting cash and crediting interest revenue for $4,000 on December 31, 2008. The amount is calculated by multiplying the $100,000 principal amount times 8% times 6 months over 12 months. The interest revenue would be the same each 6 months until maturity. Last, let's record the receipt of the principal amount at maturity on June 30, 2013. To record the receipt of the principal at maturity, we debit cash and credit held-to-maturity investments for $100,000 on June 30, 2013. Investments in debt securities that are not to be held to maturity and passive investments in equity securities are accounted for using the market value method. The investment is initially recorded at its cost. Interest received on debt securities is recorded as interest revenue. Dividends received from the investment in equity securities are recorded as dividend revenue. At each balance sheet date, the investment is adjusted to market value. As a result of the adjustment, unrealized holding gains and losses are recorded. Unrealized holding gains and losses may be reported in shareholders' equity or in the income statement, depending on the classification of the security. Consider the table on the following slide that summarizes these different accounting treatments. Trading securities are debt or equity securities that are held primarily for resale. They are actively traded with the intent of generating short-term trading profits. Securities available for sale are debt or equity securities that are not actively traded but are available for sale. Securities available for sale are held to earn a return on invested funds that may be needed for future operations. Both classifications of securities are adjusted to market value at the balance sheet date using an allowance account. This adjustment results in recording unrealized holding gains and losses. For securities classified as trading securities, the unrealized holding gains and losses are reported in the income statement. For securities classified as securities available for sale, the unrealized holding gains and losses are reported in stockholders' equity. If a security in either classification is actually sold, a realized gain or loss is recorded. If the proceeds from the sale exceed the cost of the investment, a realized gain is recorded. When the proceeds are less than cost, a realized loss is recorded. Realized gains and losses are always reported on the income statement. Let's look at an example. Part 1. On January 5, 2008, Washington Post acquires 10,000 of the 100,000 outstanding shares of iNews on the open market at a cost of $60 per share. Washington Post has no influence over iNews and does not plan to sell the shares in the near future. Part 2. Should the acquired shares be classified as trading securities or securities available for sale? Part 3. Washington Post does not plan to actively trade the shares. Instead, they will be held to earn a return on invested funds that may be needed for future operations. The shares should be classified as securities available for sale. Now, let's record the investment. The investment is recorded at cost with a debit to investment in securities available for sale. The amount is 10,000 shares times $60 per share equals $600,000. This investment may be a current asset or a non-current asset, depending on management's intended holding period. If the investment had been classified as a trading security, it would be reported as a current asset. Trading securities are always current assets. Part 1. On July 2nd, Washington Post receives a $10,000 dividend from iNews. Let's prepare the journal entry to record the dividend receipt. Part 2. We debit cash and credit investment income for $10,000. Dividend revenue is another acceptable account name for the investment income. Part 1. By December 31st, Washington Post's fiscal year-end, the market value of iNews shares has dropped from $60 to $58 per share. How much has Washington Post's portfolio value changed? Part 2. The decline in value is $20,000. Calculated by subtracting the original cost of $600,000 from the market value of $580,000. Let's record the decline in value with a journal entry. For financial reporting purposes, the investment is shown on the balance sheet at market value. We must make an entry to adjust recorded cost to market value. We assume that the existing balance in the valuation allowance account is zero. So, we debit net unrealized gains and losses on securities available for sale and credit allowance to value at market for $20,000. The unrealized holding loss would be reported in the stockholders' equity section of Washington Post's balance sheet. Here's a convenient summary comparing the accounting for trading securities and securities available for sale. Realized gains and losses, occurring when securities are actually sold, are reported in the income statement for both trading securities and securities available for sale. Unrealized gains and losses on trading securities resulting from year-end adjustments to market value are reported in the income statement. Unrealized gains and losses on securities available for sale resulting from year-end adjustments to market value are reported in stockholders' equity. Now, we are going to change the accounting for investments dramatically. We are going to assume a company has acquired enough equity securities in another company to exert significant influence over the operating policies of that company. Under the circumstances, the equity method of accounting for the investment is required. So far, we have studied the accounting for passive investments in debt and equity securities, where the investing company, the investor, lacks significant influence or control over the other company, the investee. Now, we will look at the accounting procedures using the equity method, where the investor has significant influence over the investee. Generally, we associate significant influence with ownership of between 20 and 50% of the voting common stock of the investee. Using the equity method, we will not record unrealized holding gains and losses. Instead, the investor's carrying amount for the investment is adjusted for dividends received and a percentage share of the investee's income. Using the equity method of accounting, the investor records the initial investment at cost. Each reporting period, the investor increases the balance in the investment account for the company's proportionate share of the investee's reported income. When dividends are received from the investee, the investor reduces the balance in the investment account. This accounting may appear strange at first, but remember that the investor company can exert significant influence over the investee, so special accounting is in order. If the investee has a loss instead of income, the investor decreases the balance in the investment account for the company's proportionate share of the investee's reported loss. Let's look at an example. Part 1. On January 2nd, Telecom Incorporated acquires a 30% interest in Sports.com at a cost of $2 million. Let's prepare the journal entry to record Telecom's investment. Part 2. On the date of acquisition, Telecom Incorporated will debit the long-term investment in Sports.com and credit cash for $2 million. Now, let's look at the accounting treatment for the recognition of the investor's proportionate share of the investee's income. Part 1. Sports.com's net income for the year is $1,600,000. Telecom's 30% share is $480,000. Let's prepare the journal entry to record Telecom's share of Sports.com's income. Part 2. Telecom will debit or increase the investment account and credit equity in investee earnings for $480,000. The equity in investee earnings from the investment in Sports.com long-term investment will appear on Telecom's income statement. Now, let's look at the accounting treatment for the receipt of dividends. Part 1. On March 31st of the next year, Sports.com pays $200,000 in dividends. Telecom's 30% share is $60,000. Let's prepare the journal entry to record Telecom's receipt of the dividend. Part 2. Telecom will debit cash and credit the investment account for $60,000. Dividends are not revenue with the equity method. Using the equity method, we view the receipt of dividends as a return of a portion of the investment. So we reduce the investment account when dividends are received. Part 1. The purchase of investments made in securities of other companies results in a cash outflow. The sale of investments made in securities of other companies results in a cash inflow. These two cash flows are reported in the Investing Activities section of the Statement of Cash Flows. Part 2. Several items relating to the accounting for investments are reported as adjustments to net income in the Operating Activities section of the Statement of Cash Flows prepared using the indirect method. These adjustments to net income are: a gain on sale of an investment is subtracted from net income. A loss on sale of investment is added to net income. The equity in earnings of an investee is subtracted from net income. Dividends received from an investee are added to net income. Unrealized holding gains on trading securities are subtracted from net income. Unrealized holding losses on trading securities are added to net income. Remember that unrealized holding gains and losses on securities available for sale are reported in the stockholders' equity, so an adjustment to income is unnecessary. When an investor owns more than 50% of the voting common stock of the investee, the investor controls the investee. The investor continues to use the equity method of accounting for the investment, but at the end of the year, the investor and investee financial statements are consolidated into one set of statements for both companies. The principal reasons that an investor might acquire a controlling interest in an investee are for horizontal growth, vertical integration, and/or for synergy. Horizontal growth refers to acquisitions of companies at the same level in the channels of distribution. Vertical integration refers to acquisitions at a different level in the channels of distribution. Synergies occur when two companies realize cost savings or other benefits as a result of combined operations. The investor is usually referred to as the parent company, and the investee is usually referred to as the subsidiary company. Consolidated statements combine the operations of the companies into a single set of statements. In the process of consolidation, any transactions between the parent and subsidiary are eliminated. Goodwill does not exist separate from the company itself. It represents the value of a company as a whole over and above its identifiable net assets. Goodwill may be attributed to many factors, including good reputation, superior employees and management, good clientele, and good business location. Only purchased goodwill is recognized. Purchased goodwill results when one company buys another company for a price that exceeds the fair value of the separate identifiable net assets acquired. Let's look at an example of how we record an acquisition of another company. Part 1. Washington Post paid $100 million in cash to purchase all the stock of iNews. Washington Post merged iNews operations into its own operations, and iNews ceased to exist as a separate entity. The following information is taken from iNews' balance sheet at the date of acquisition. Plant and equipment, net, $30 million. Other assets, $60 million. Total assets, $90 million. Current liabilities, $10 million. Net assets, $80 million. Part 2. Should Washington Post record goodwill? Remember that goodwill results when one company buys another company for a price that exceeds the fair value of the separate identifiable net assets acquired. We know the purchase price is $100 million, and we know that the book values of the net assets total $80 million, but we don't yet know the fair value of the net assets acquired. Proceed to the next slide for fair value information. Part 1. Washington Post determined that iNews plant and equipment had a fair value of $35 million. The book value at the acquisition date was $30 million. The balance sheet amounts for other assets and current liabilities are fair values. How much goodwill results from this transaction? Part 2. Goodwill results when one company buys another company for a price that exceeds the fair value of the separate identifiable net assets acquired. The purchase price is $100 million, and the fair value of the net assets is $85 million, so Washington Post would record $15 million of goodwill. Let's prepare the journal entry to record the acquisition. We record the acquisition at Washington Post's cost by debiting plant and equipment for its fair value of $35 million, debiting other assets for $60 million, debiting goodwill for $15 million, crediting current liabilities for $10 million, and crediting cash for $100 million. Goodwill is not amortized. Each year we must test to see if there has been any impairment in the carrying value of the goodwill. If an impairment is determined to exist, we will reduce the goodwill account and recognize the loss in value. Return on assets measures how much a company earned for each dollar of investment. It is an indication of how well assets have been employed in the business. In general, a higher return indicates management is doing a better job selecting investments. Return on assets is calculated by dividing net income plus interest expense, net of tax, by the average total assets for the period. Because creditors provide financing for a portion of the assets, we add interest expense to income in the numerator of the ratio. For the year 2006, Washington Post had $324,469 of net income. Interest expense was negligible. End-of-year assets were $5,381,372, and beginning-of-year assets were $4,584,773. All numbers are in thousands. Let's compute the 2006 return on assets for Washington Post. The return on assets of 6.5% is calculated by dividing net income by average total assets. As you can see, Washington Post and two other news organizations have comparable return on assets. Chapter Supplement A. Preparing Consolidated Statements. When one company acquires another company, and both companies continue their separate legal existence, consolidated financial statements must be prepared. Let's revisit the Washington Post acquisition of iNews, assuming both companies continued their separate legal existence, and prepare consolidated financial statements. Part 1. Washington Post purchases all of the stock of iNews for $100 million cash. iNews net assets, assets less liabilities, are $80 million at the date of purchase, but have a fair market value of $85 million. How much goodwill results from this transaction? Part 2. Goodwill results when one company buys another company for a price that exceeds the fair value of the separate identifiable net assets acquired. The purchase price is $100 million, and the fair value of the net assets is $85 million, so Washington Post would record $15 million of goodwill. How much is the fair value adjustment to the assets acquired? Part 3. The fair value of the net assets acquired is $85 million, while the carrying value on iNews books is $80 million, so the fair value adjustment is $5 million. Consolidated statements are prepared for investments in equity securities of another company that result in greater than 50% ownership. Washington Post owns 100% of iNews, so consolidated statements are prepared. Consolidated statements combine the operations of the companies into a single set of statements. First, let's prepare a consolidated balance sheet. With the exception of the investment in iNews account, The assets and liabilities of the two companies are added. The $100 million investment in iNews account is eliminated, 1. Against the $80 million stockholders' equity of iNews, 2. By adding the $5 million fair value increment to plant and property, and 3. By including the $15 million of goodwill. Now let's prepare a consolidated income statement. The revenues and expenses are added. There is an additional $1 million of depreciation resulting from depreciating the $5 million fair value increment over 5 years using the straight line method with zero salvage value. The additional depreciation reduces the total income from $338 million to a combined total of $337 million. End of Chapter 12.